History doesn't repeat itself, but it often rhymes, said Mark Twain. Those who do not understand the historical trends in economics may be unprepared for the future. Post-World War II, many European nations found themselves dealing with towering mountains of debt, their economic stability hanging by a thread. So, what did they do to deal with their debt burden? A subtle yet powerful tool known as financial repression. Governments, in a bid to lighten their debt burdens, turned to this strategy to erode their obligations stealthily, like water shaping a rock over centuries. But what exactly is financial repression? And why should it matter to you, today, decades after the end of World War II? As global debt levels soar, understanding this economic phenomenon is more crucial than ever. This is more than just a historical event. It is a current chapter that is unfolding before us, with far-reaching impacts on our economies, influencing interest rates, savings, and the foundation of our financial independence. Join us as we peel back the layers of financial repression, uncover its mechanisms, and reveal how it's silently shaping our economic landscape. Whether you're a saver, investor, or just someone curious about the economic world, this journey will equip you with the knowledge to navigate the complex currents of modern economics. Because in a world where the past echoes in the present, understanding financial repression isn't just about studying history, it's about preparing for the future. Over the last 20 years, the government debt in many countries have risen rapidly, especially in the aftermath of the financial crisis of 2007 and more so after the COVID pandemic. For example, in the UK, the government debt is said to be at 101% of the GDP as reported by the mainstream media. But if you dig into the figures from the Office of National Statistics, the UK government has unfunded state pension liabilities of £4.8 trillion, which is 224% of GDP, and unfunded public sector liabilities of £1.2 trillion, which is 55% of GDP. Together with an aging population, the UK government will find it increasingly difficult to service its obligations. This is the same in many countries in Europe. One way of dealing with this is to impose severe austerity and raise taxes at the same time. But no government will do this, as this will be very unpopular and they will be immediately voted out. So it has been proposed that they turn to the history books and use the stealth way of reducing their obligation by financial repression. So, what is financial repression? Financial repression refers to a set of governmental policies that keep real interest rates low or negative and regulate capital movement to secure low-rate funding for government debt. Real interest rates refer to the difference between nominal interest rates set by central banks and inflation. Key features of financial repression: artificially low interest rates. Central banks might set lower than market interest rates, reducing the government's borrowing costs for its debt. For savers and investors, this means getting returns on savings and fixed income investments that may not keep up with inflation. Capital controls. Restrictions on the movement of capital across borders can prevent investors from seeking higher returns abroad, effectively trapping capital within a country to fund government debt or other domestic investments. Many people do not know that the UK had capital controls until 1979. So this is not a new thing. It has been done in the past, and it could be enforced in the future. Government ownership or control of banks. When governments have significant influence over banks, they can pressure these institutions to invest in government securities, providing a captive audience for government debt. This will reduce their profits. Governments may use regulations or moral persuasion to cap interest rates, potentially affecting the returns investors receive on their capital. This is like a stealth tax, as the cash invested in the banks earns a lower interest rates than the real rate of inflation. Implications of financial repression. Expanding on the key features of financial repression, We delve deeper into the mechanisms and potential outcomes of such policies, illustrating how they interplay with broader economic and societal aspects. Forced low interest rates amidst high inflation. Governments, through their central banks, might maintain artificially low interest rates to reduce the cost of servicing their debt. This scenario often occurs even in the face of rising inflation, leading to negative real interest rates where the rate of inflation exceeds the interest earned on savings and investments. This erosion of real value discourages savings, as the purchasing power of the returns fails to keep pace with inflation, impacting consumers and investors alike. Mandatory investment in government debt. Governments may require banks, pension funds, and other financial institutions to hold government bonds, often offering below-market returns. This directive limits these institutions' ability to allocate capital freely, potentially diverting funds from more productive private sector investments. The mandated purchase of government securities can crowd out private investment, stunting economic growth and innovation. Reduced capital availability for productive investments. With a significant portion of capital locked into low-yield government debt, the availability of funds for businesses and entrepreneurs can diminish. This limitation can stifle economic growth, innovation, and job creation as firms struggle to access the financing needed for expansion and development. Risk of currency devaluation. To manage or reduce the real value of debt, governments might resort to policies that can lead to currency devaluation. A sudden drop in currency value can erode international investor confidence and harm the economy's international trade dynamics, leading to increased costs for imports and potential inflationary pressures. Government confiscation of assets. Historical precedents, such as the U.S. government's gold confiscation under President Roosevelt, highlight the extreme measures governments might take under financial repression regimes. By seizing assets, the government can bolster its reserves to manage or reduce national debt, but such actions can undermine property rights and investor confidence. Introduction and enforcement of central bank digital currencies. CBDCs. The advent of CBDCs offers governments unprecedented control over the monetary system. With digital currencies, authorities can enforce negative interest rates, impose capital controls, and track financial transactions meticulously. While the promotion of cryptocurrencies might acclimatize the populace to digital currencies, governments could eventually outlaw decentralized cryptocurrencies to eliminate competition and consolidate control over the financial system. Transition from cryptocurrencies to CBDCs. The current interest and encouragement of cryptocurrencies by some governments could be a strategic move to familiarize the public with digital currencies. This transition could pave the way for a seamless adoption of CBDCs, after which point, similar to the historical precedent with gold, governments might restrict or ban independent cryptocurrencies to centralize control and enhance regulatory oversight. Turning the pages of history, this is what happened to gold in the 1930s. When President Franklin D. Roosevelt issued Executive Order 6102 in 1933, requiring U.S. citizens to turn in their gold in exchange for $20.67 per ounce, the government set price was roughly in line with the market price of gold at that time. However, the key issue that arose was not necessarily about the fairness of the price at the moment of the exchange, but what followed after the gold was collected. In 1934, the Gold Reserve Act revalued the price of gold to $35 per ounce. This significant increase in the gold price, which came after the government had already collected gold from private citizens, meant that the government effectively devalued the dollar by 41%. Citizens who had surrendered their gold at $20.67 per ounce could not benefit from this increase. If they had been able to retain their gold, they would have seen a substantial increase in its value in dollar terms. So, in hindsight, while the initial exchange rate was market appropriate, The subsequent revaluation meant that individuals who surrendered their gold received less value than they would have if they had been able to hold onto their gold and sell it after the devaluation. This revaluation was part of a broader strategy to combat deflation and stimulate the economy, but it also meant that those who had turned in their gold missed out on a potential gain in value. In conclusion, financial repression encompasses a broad array of government strategies aimed at reducing public debt burdens at the expense of savers and investors. While these measures can provide short-term relief for government debt levels, they often come with long-term economic costs, including reduced investment, economic growth, and potential infringements on individual financial freedom. Navigating financial repression. Navigating financial repression requires a strategic and informed approach to investment, recognizing the broader economic context and potential government interventions. Here are expanded strategies to safeguard and grow your assets in a financial repression environment. Invest in real assets. Real estate, commodities, and equities tied to real assets can offer protection against inflation. Real estate in countries with low debt levels is less likely to be subject to financial repression and capital controls. However, be mindful of the potential for rent controls, which can be a form of financial repression affecting property income. Diversify internationally. International diversification can mitigate the risks of domestic financial repression. Investing in real estate or equities in countries with robust fiscal health reduces exposure to countries where high debt levels might lead to aggressive financial repression policies. Consider equities in dollar-earning companies. Companies that earn revenue in U.S. dollars, such as multinational commodity firms, can benefit from dollar devaluation as their foreign income increases in value when converted back to dollars. Their global footprint also diversifies risks related to any single country's financial repression policies. Energy sector investments. Governments might have incentives to increase energy prices as a way to induce inflation, impacting almost every sector of the economy. Investing in energy companies can provide a hedge against such inflationary pressures, as these firms may benefit from rising energy prices. Self-managed pensions. If possible, manage your own pension funds, especially in environments where pension funds are mandated to invest heavily in low-yield government bonds. This autonomy allows you to seek investments that better hedge against inflation and financial repression. Skepticism towards bank stocks. Financial repression can erode the profitability of banks, as they may be required to hold government debt with yields below inflation. This pressure can affect their earnings and, by extension, their stock performance. Caution with cryptocurrencies. While cryptocurrencies offer an alternative to traditional financial systems, there's a risk that governments might ban them to pave the way for central bank digital currencies, CBDCs. If this transition occurs, the value exchange from cryptocurrency to CBDC might not be favorable. Invest in low-debt countries. Equities in countries with low public debt are attractive as these nations are less likely to resort to financial repression. Capital tends to flow to markets offering higher real returns, making these countries potential havens for investment. Avoid over-reliance on government pensions. Government pension values can erode in real terms due to inflation or policy changes. Diversify your retirement savings across different asset classes and jurisdictions to reduce reliance on any single source of retirement income. Let's give you an example from history. During the Greek financial crisis, which peaked between 2009 and 2018, Greek pensions underwent significant cuts as part of the austerity measures imposed by the government to secure bailout funds from the European Union, EU, International Monetary Fund, IMF, and the European Central Bank, ECB. These cuts were part of broader efforts to reduce public spending and address the country's debt crisis. Extent of pension cuts. Multiple cuts. Greek pensions were cut several times during the crisis. By some accounts, there were over a dozen separate cuts, impacting both primary and supplementary pensions. Magnitude of cuts. The pension reductions varied, with some retirees experiencing cuts of up to 50% or more over the crisis period. The average cut was substantial, significantly affecting the income of retirees. Impact on retirees. These cuts had a profound impact on Greek retirees, many of whom saw their monthly income drastically reduced. This led to increased poverty rates among the elderly and widespread social unrest. Supplementary pensions. In addition to primary pension cuts, supplementary pensions, which are additional retirement income sources, were also significantly reduced or even entirely scrapped in some cases. Reform measures. The pension reforms included recalculating pension amounts, merging various pension funds, and increasing the retirement age. The goal was to make the pension system more sustainable in the long term, but these changes had immediate negative effects on retirees. Legal challenges. Some of the pension cuts were challenged in Greek courts, and the Greek Council of State, the highest administrative court in Greece, ruled several times that certain pension cuts were unconstitutional. Despite this, the financial reality forced continued adjustments. Long-term consequences. The pension cuts contributed to a decline in the standard of living for many Greek retirees, affecting their ability to afford basic needs and leading to broader economic and social implications for Greek society. The Greek pension cuts remain a poignant example of how severe financial crises can lead to drastic measures impacting the welfare of citizens, particularly vulnerable populations like retirees. It also underscores the challenges of balancing fiscal sustainability with social welfare in times of economic distress. Emigrate to countries with lower debt. This will be a good option if you are young, as there will be less taxation in these countries compared to countries with high incomes. This is especially important if CBDCs are introduced, as this will greatly enhance the power of the government to control the population. Consider the case Nigel Farage, whose bank accounts were closed for his political opinion. CBDCs will enable the government to cancel anyone they want if they hold opinions which doesn't align with the government. Save in tax-efficient investments. As much as possible, you should save in tax-efficient wrappers to protect these savings from government tax. Examples in ISA, SIPP, IRA. By understanding the mechanisms and implications of financial repression, investors can adopt strategies to protect and potentially grow their assets even in challenging economic times. Staying informed, diversifying across asset classes and geographies, and maintaining flexibility in your investment approach are key to navigating the complex landscape of financial repression. We hope you liked this video, and if so, please like, share, and subscribe. Thank you.